in actual policy making, you don't even know what the current quarter GDP is, because it's going to get revised, several times down the road. I remember when I was sitting just as a member of the board, and Greenspan was in the chair, and we had responded to some inflation data, and a little bit later, it turned out that inflation change had been revised away. And I asked the chair, do you think we can revise our interest rate policy? It is very difficult. I mean, got to laugh with that, but, just trying to make policy, it involves not just uncertainty about, the data, about the model, about all the things that can happen, about the social and economic and political environment. So it's very difficult. And unfortunately, or fortunately, given that monetary policy works with a lag, given that there are risks on both sides of the modal forecast, there's not much choice but just to accept that uncertainty and try and do the best you can, being ready to adjust as new information arrives.
Very good. Thank you. We are getting close to the end of our allotted time. Maybe we could wrap up with just a question looking ahead. Jay, maybe we can start with you. What would you point to as some of the key issues that will be most relevant to the research community as well as to the policymaking community?
So I guess I would start with the labor market, and what we talked about earlier of vacancies in particular, and the beverage curve, and the whole discussion over whether the extraordinarily high level of surplus demand in the labor market can be lessened through the vacancies channel without a significant increase in unemployment. That would be more akin to what has happened in all prior cycles, or most prior cycles. So that's going to be a question that we will resolve empirically. But I think we're learning new things about the workings of the labor market, at least in this one situation. I think on monetary policy, it's going to be interesting to look back and try to understand how inflation spread from what was at the beginning, very focused on the goods sector due to the rotation of demand from services to goods, and the tremendous amount of support that goods purchases got from fiscal and monetary stimulus. How did it spread then through really into the service sector, where it now significantly resides? I think we're seeing much progress on goods, and we have progress in the pipeline on housing services, but where we see persistent inflation is now in the service sector. So what is the mechanism by which that happens, and what are the implications?